Hello friends, welcome to our channel, The Wealth Mantra. Whenever a person plans to move to abroad or whenever a person plans to move back to India, apart from lot of things going in mind about relocation, there is always a confusion with respect to residential status. Whether I will be resident or non-resident, how income will be taxed, whether I can hold an RE account and deposits, how many days are allowed to stay in India, what if I am going out for employment, what if I am coming back for employment. All these questions come into the mind of an individual. So friends, I am Reema Bansal and today we are going to examine and share different aspects of residential status of an individual. So friends, why residential status is important? Residential status is important to determine the type and extent of transactions that can be entered cross borders and also how the income will be taxed. So there are basically two laws which cover the residential status: Income Tax Act and FEMA, Foreign Exchange Management Act. Income tax covers how income will be taxed. How income in NRE and NRO account will be taxed is decided as per Income Tax Act. FEMA, Foreign Exchange Management Act, is a regulatory law that lays regulations for undertaking transactions. For example, whether you can open NRE or NRO account if you qualify as NRI as per FEMA. Your residential status as per FEMA will decide whether you can invest in mutual fund as a resident or as a non-resident Indian. Here residential status as per Income Tax Act doesn't matter. So FEMA decides the type of transactions that can be undertaken and income tax decides how the income will be taxed. So now let's first see the residential status as per Income Tax Act. As per Income Tax Act, an individual can be resident in India, resident but not ordinarily resident in India, RNOR, or a non-resident Indian. After finding out the residential status of an individual only, we can determine the type of income that will be taxed in India. If a person is resident in India, his entire global income will be taxed in India. That is income that is received or deemed to be received in India, income which accrue or arise in India or deemed to accrue or arise in India, income which accrue or arise outside India. All income will be taxable in India. In case of resident but not ordinarily resident, RNOR, income that is received or deemed to be received in India, income which accrue or arise in India or deemed to accrue or arise in India, income which accrue or arise outside India from the business which is controlled in India will be taxable in India. And in case of non-resident Indian, tax incidence is only on income which is received or deemed to be received in India or income which accrue or arise in India or deemed to be accrue or arise in India. So, residential status is important to determine which income will be taxable in India and which income will not be taxable in India. So, now let's first understand how to determine residential status as per Income Tax Act. To be resident in India, any of the two conditions should be satisfied. First condition is number of stay in India must be 182 days or more during the financial year. Second condition is number of stay in India must be 60 days or more during the financial year and 365 days or more during the 4 preceding financial years. So if any of the two conditions are satisfied, then the person will be resident in India. Now in the second condition, in which we said that the stay in India must be 60 days or more, there are few exceptions to the rule. First exception is if you are going out of India for employment, then that 60 days will be considered as 182 days. Second exception is if you are leaving India as a crew member of an Indian ship, then also that 60 days will be considered as 182 days. Now the third exception is if a citizen of India or a person of Indian origin comes to India on visit and total income other than income from foreign sources is less than or equals to rupees 15 lakhs rupees, then instead of 60 days we will see 182 days. And the fourth exception is if you are a citizen of India or a person of Indian origin and you comes to India on visit and your income other than income from foreign sources is more than 15 lakhs rupees, then instead of 60 days 120 days will be considered. This third and fourth exceptions are made applicable as per Finance Act 2020, and this may complicate matters for few. So friends, now we can see when a person can be resident in India. After this, we need to find out whether a person can be resident but ordinarily resident or a person is resident but not ordinarily resident. RNOR. So a person will be resident but not ordinarily resident if any of the two conditions are met, and the two conditions are, first one is he is NRI in 9 out of 10 years preceding the financial year, and the second condition is stay in India is not more than 729 days during the 7 preceding financial years. If any of the two conditions are met, then the person will be resident but not ordinarily resident. Recently in Finance Act 2020, more subsections have been introduced in which a citizen of India or a person of Indian origin whose total income other than income from foreign sources is exceeding rupees 15 lakhs rupees and he is not taxable in any other country because of his domicile or residence, then he will also be considered as resident but not ordinarily resident. Here there is no reference as to number of days, and it seems to cover high net worth individuals who plan their number of days in India to avoid tax. So this was all about arriving at residential status as per Income Tax Act. One important thing to note here is that arrival and departure date, both days are to be considered as in India. Second thing is, due to COVID-19, CPTT has issued a circular in which stay in India from 22nd March 2020 to 31st March 2020 will not be included in calculating the number of days of stay in India, and similar circular will also be issued for financial year 2021 when international flights will start operations. Now under FEMA, as I told you earlier, Foreign Exchange Management Act is a regulatory law which lays regulation for undertaking transactions. Your residential status as per FEMA will decide what type of transactions can be undertaken. So a person will be resident in India as per FEMA if he stays in India for more than 182 days during the preceding financial year. Under the Income Tax Act, it was 182 days or more during the financial year. Here it is more than 182 days during the preceding financial year. There are few exceptions to this. First one is if you are going out of India for employment. Second one is if you are going out of India for carrying out any business or vocation. Third one is if you are going out of India for any purpose that indicates that your intention to stay is for uncertain period. Then even if your stay is for more than 182 days in India, you will be considered as resident outside India. So a person will be resident outside India as per FEMA if his stay in India is for 182 days or less than 182 days during the preceding financial year. Here also there are few exceptions. If you are coming to India for employment, if you are coming to India for carrying out any business or vocation, if you are coming to India for any purpose that indicates that your stay is for uncertain period, then even if your stay is for 182 days or less than 182 days, you will be considered as resident in India. For example, if a person is moving out of India for employment, say on 15th March 2020, then he will be as non-resident Indian from that day only. Similarly, if a person comes to India for employment, then he will be considered as resident in India from that day only. So it's clear, when a student leaves India to study abroad, then he will be considered as non-resident from day one only. So now we can see the difference between the residential status as per the Income Tax Act and as per Foreign Exchange Management Act. Under Income Tax Act, stay in India is 182 days or more, but under FEMA, it is more than 182 days. Second difference is, under the Income Tax Act, the year in which number of stay is seen is the current financial year. But under the Foreign Exchange Management Act, we see number of stay during the preceding financial year. Under the Income Tax Act, reason to stay in India or to go out of India doesn't matter. In few cases, there are difference in number of days. But under FEMA, reasons to stay in India or to go out of India does matter. Fourth difference is, under Income Tax Act, if you will be resident, then you will be resident for the whole financial year. If you will be non-resident, then you will be non-resident for the whole financial year. But under Foreign Exchange Management Act, under FEMA, you can be resident for the part of the year or you can be non-resident for another part of the year. So friends, this was all about arriving at residential status as per Income Tax Act and as per FEMA. Please do like the video and do share with your friends and relatives. Our motive is just to share the knowledge. If you have any queries related to this topic, you can ask in the comment section. We usually reply within few hours. You can also suggest new topics for our upcoming videos. Do subscribe our channel, The Wealth Mantra, and please press the notification bell so that you can receive notification for all our upcoming videos. So this is CA Reema Bansal. Thanks for watching.